Hello and welcome to this video on the incidence of taxation. So it's time for taxes. In this video we're going to look at the difference between direct and indirect tax, explain the concept of the incidence of taxation, and understand the circumstances under which the incidence falls mainly on the consumer or mainly on the producer. So let's get started. Taxation, the what and the why. Well, a tax is a compulsory charge made by the government on goods, services, income or capital. The purpose is to raise funds to pay for government spending on things like hospitals, schools, etc., but also sometimes to change consumer behaviour. So we might tax something that we don't want people to consume too much of. There are two broad types of taxes. The first one is a direct tax, and this is applied directly on an individual or organisation. And they're usually paid on incomes, for example, income tax or corporation tax, and they're taken directly off you. It's very difficult to avoid paying these types of taxes. Second category of tax is an indirect tax, and these are usually applied when you buy a good or a service. And there are two main types, specific and ad valorem, and we'll look into these two now. A specific tax is charged as a fixed amount per unit of a good. So for example, you might have a €2 tax on a pack of cigarettes. So that is a tax, that amount that applies every time you buy a particular unit of a good. It doesn't change. An ad valorem tax is charged as a percentage of the price. So for example, if you have value added tax at say 20% and a meal costs £10 or €10, then you add on 20% tax, would be £2, €2, and that would be your final price with a tax on top. If the cost of providing the same good or service was actually €20 and value added tax was 20%, then you'd be adding on €4 to the price. So you'd be paying €24 or £24 in total. So this changes, the actual amount you pay changes depending on the cost of the product that you're buying. So now let's move on to look at the incidence of taxation. Before we do that, we need to look at the impact on the supply curve. And here we're talking about indirect taxes, so specific or ad valorem. So here is a supply curve, and let's have a look at the impact of an indirect specific tax. So here we can see that there's a flat rate applied to each unit of the goods. The amount that's been added on to each good is the same. So we've got a shift here for a specific tax. Look at ad valorem, what we can see is actually we've got a different amount. So the amount of tax actually increases the higher the price. So for example, if we imagine that this was €10 here, and we're adding on 20%, then this would be 2. But if we imagine over here that this here is maybe €20, and we're adding on 20%, then this would be not 2, but 4. So we can see the gap gets wider as it gets higher because this is a percentage. We're adding on a percentage each time. So what is the impact of a tax on the market price and quantity? Well, here we've got our market with a price P1 and a quantity Q1. Use a specific indirect tax that would shift the supply curve to the left. And this will move the market equilibrium too. But what we notice is the price doesn't actually go to P1 plus the value of the tax. So the full market price hasn't gone up by the value of the tax. Some of the extra price, some of the tax has been seen in rising prices, but not all of the tax is seen in a rise in price. So the consumer has noticed some of the rise in price from P1 to P2, but the rest of the tax must be coming from the producer. And so we call this who is paying for the tax, is it the consumer or the producer, the incidence of tax, which we're going to look at now. So the incidence of tax measures the burden of tax on the taxpayer. The tax burden may be shared by consumers and producers. So let's have a look at an example. We can see here, this is our same example from last time, that the introduction of an indirect tax has caused the price to rise from P1 to P2. Now, if you're the consumer, that's what you would notice. You would see the price going up from P1 to P2. So your share of the tax would be associated with this rise in price. Now the rest of the value of the tax must be coming from the producer. And if we think about the tax revenue in total, the total tax revenue that goes to the government, that will be indicated like this. We can see that at the moment we've got Q2 being produced, units, and the tax is this value here. This yellow line is the value of the tax. So if it applies from 0 to Q2 for that value, then the total tax revenue that's being generated is indicated by this white box. And so that's a total amount of money going to the government. And what we can do is break that down and say, right, well, this share here, the difference between P1 and P2, is how much the consumers are contributing, because they contribute through the higher price. The rest of it, by definition, must be coming from the producer. And that is going to be eating into their profits. So their profits will be reduced by this amount of tax that they're paying. So we've looked at the incidence of taxation. Now let's look at when it mainly falls on the consumer and mainly falls on the producer. And this depends on the different elasticities of demand. So in this scenario, we have very price inelastic demand. Producer tax, we can see that there's a big change in price from P1 to P2, which is a large consumer share of the tax that's being paid. They must come from the producer. But here it's quite small. Now, because consumers aren't that sensitive to price, when it's price inelastic, we can see that a large proportion of the tax has been passed on to the consumer in terms of higher prices. In this scenario here, we have quite price elastic demand. And when the tax has been introduced, a slight rise in price from P1 to P2. Here's the consumer's share. It's relatively smaller. Now the rest of the tax, the rest of the amount of tax, the difference between the two supply curves, must now be the producer. So the producer's share here is quite large compared to the consumer when we have elastic demand. And that's because consumers are quite responsive to changes in price. They're not prepared to pay the higher price when the tax is applied. And you can see there's also quite a big fall in the quantity. Let's have a look with supply. When we have inelastic supply, see that the price rise is relatively small. The producer is paying a large share of the tax. When supply is more price elastic, we can say there's been a large jump in price, and so the consumer will be paying a larger share of the tax. The producer's share will be relatively small. So this page shows us a summary of what we've just been looking at. It might be worthwhile taking a screenshot of this, printing it out and putting it in your notes. So in this video, we've looked at direct and indirect taxes. We've focused mainly on indirect taxes, specific and ad valorem, and we've explained the incidence of taxation using specific indirect taxes. We've also looked under the circumstances under which the tax incidence falls mainly on the consumer and when it falls mainly on the producer. That's it. Thanks for listening.